All right, let's dive straight into this masterclass designed specifically to help you guys in grade 12 completely conquer Chapter 12 on inflation. Whether you're just aiming for a solid pass or you're chasing down that distinction, getting your head around inflation is absolutely crucial, mostly because it touches almost every single part of your economics paper. In this explainer, we're going to break down all the complexities, look at exactly what your examiners are hunting for, and lock the most important concepts right into your memory.
Here is our roadmap for this explainer. We'll quickly cover the core foundations, dive into the mechanics, explore the ripple effects, discuss combating inflation, break down your exam strategy, and then wrap up with a revision checklist.
Okay, starting with Section 1, Core Foundations. What actually is inflation?
So here's the absolute crucial point. Inflation isn't just some quick price jump. Like if the price of an apple spikes for a week because of a bad harvest, that is not inflation. Inflation is a sustained and significant increase in the general price level over a real period of time. And the direct result of this, a brutal simultaneous decline in the buying power of your money. Your rand literally buys you less today than it did yesterday. Now make sure you don't confuse this with deflation, which is an actual decrease in prices, or disinflation, which is simply a slowdown in the rate of inflation.
Now, to put a number on it, when we talk about price stability here in South Africa, the Reserve Bank, the SARB, uses a strict inflation targeting framework. They are literally aiming to keep inflation inside a 3 to 6% band. That specific mandate is set directly by the Minister of Finance. Keeping inflation inside this target sweet spot ensures that prices are relatively stable, which encourages economic growth without letting the cost of living just completely spiral out of control.
You're definitely going to want to know the exact difference between CPI and PPI. This is a classic, highly testable Section B question for sure. CPI is all about your cost of living. It measures a basket of consumer goods and services, and yes, it includes VAT and interest rates. PPI, on the flip side, measures the cost of production right as goods leave the factory floor. Notice that PPI looks at goods only, including big capital goods. It totally excludes VAT and interest rates, and it explicitly shows you the prices of imported goods. So when the rand weakens, you'll actually see it hit the PPI first. And while CPI is our best tool, remember, it's not perfect. It's an average basket, so it doesn't perfectly mirror every single household's actual spending.
Now, zooming in on consumer inflation, you absolutely must be able to tell headline, core, and administered prices apart. Headline inflation is just the raw, unadjusted CPI figure. Core inflation, though, strips out all the noisy data. It removes highly volatile items like fresh meat, fish, and veggies, and ignores things affected by government policy, like VAT. Administered prices? Well, they're exactly what they sound like. Prices directly set or controlled by the government or appointed authorities.
Moving on to Section 2, the mechanics, types and causes of inflation. Okay, so what actually triggers this whole thing? It basically comes down to two main forces: demand pull and cost push. Demand pull is the classic too much money chasing too few goods scenario. Consumers are aggressively demanding more than the economy can supply, so prices just get pulled right up. Cost push is the total opposite. Here, supply-side shocks, think rising global oil prices, a weak rand making imports way more expensive, or massive wage increases, push up the actual cost of production. Businesses then just pass those higher costs on to us, the consumers. Oh, and if these prices just creep up slowly and steadily over time, we just call that creeping inflation.
If an exam asks you what specifically causes that demand pull inflation, these are the exact triggers you need to drop to secure your marks. It can spark from households spending a ton because credit is cheap or taxes are low. It could be investors pouring cash into businesses because they expect big profits. It might be the government pumping massive amounts of money into new infrastructure or social programs. Or it can literally come from foreigners aggressively buying up our exports when we haven't actually increased local production to match the demand.
And, we absolutely cannot skip the monetarist here. They bring a very specific mathematical formula to the table. Based on the quantity theory of money, MV equals PT. Basically, their argument is super direct. If monetary authorities increase the money supply way faster than the economy is actually growing, high inflation is just guaranteed to follow. Basically, print too much money, and prices will inevitably skyrocket.
Now watch out for stagflation. Examiners love to test this one because it's kind of a nightmare scenario. Usually, inflation happens when the economy is booming, right? But stagflation is this brutal situation where the economy completely stagnates, growth is super low, people are losing their jobs left and right, but prices are still aggressively climbing. It breaks all the usual rules, making it incredibly difficult for any government to fix.
On the totally extreme end, we have hyperinflation. We're talking about inflation rates soaring above 50%. When money loses its value so incredibly fast, citizens just completely abandon the currency. Like they completely lose all confidence in the cash and literally start bartering, trading physical goods for other goods just to survive the day. All right, Section 3. The ripple effects. Consequences of inflation.
So what's the real-world fallout? Ultimately, unmanaged inflation means your money literally stops working. Your purchasing power tanks. The most vulnerable people, especially those on fixed incomes like pensioners, are hit the absolute hardest. Because their income stays completely flat while the cost of surviving shoots up every single day, it wildly redistributes wealth from savers to borrowers, and it creates the super dangerous wage-price spiral. Workers demand higher wages to survive, which just forces businesses to raise prices again. Plus, it creates massive balance of payments problems because our exports suddenly become too expensive and uncompetitive globally, creating this deep economic uncertainty that completely scares off investors.
Let's flip to Section 4, Combating Inflation, specifically looking at monetary policy measures.
This right here brilliantly illustrates the monetary transmission mechanism. You absolutely have to trace this exact step-by-step logic in your Section C essays. Okay, so when inflation runs too hot, the SARB steps in and increases the repo rate. That's the rate they charge commercial banks. Those commercial banks instantly pass that pain on to you by raising interest rates on your everyday loans. Because borrowing is suddenly way more expensive, both consumers and businesses borrow less and therefore spend less. That drop in spending cools down aggregate demand, successfully pulling down that demand pull inflation.
But the repo rate isn't the SARB's only weapon. Through open market transactions, they can literally drain excess money out of the economy by selling off government securities. They can also just slap down direct credit restrictions, forcing commercial banks to lend less money. Or they can use what's called moral suasion, which is essentially the central bank applying heavy moral pressure, strongly advising financial institutions to be way more cautious when granting credit. And remember, the government can jump in too, using fiscal policy, like raising taxes or cutting government spending, or they can use supply-side measures to boost productivity and lower production costs.
Which brings us perfectly to Section 5, Exam Strategy and Maximizing Your Marks. Just knowing the theory isn't quite enough. You gotta know exactly how the examiners are gonna test you on it. In Section A, it's a precision game. You need word-perfect definitions for concepts like stagflation and the repo rate. Over in Section B, they're probably going to hit you with an extract, maybe a cartoon or a data table showing fuel levies or price indexes. You need to quickly identify the specific type of inflation and instantly link it to how the government should respond. And for Section C, it is all about structure.
For that massive 30-mark Section C essay, use this exact 4-step blueprint. Start with a crystal clear definition in your intro, then move right into your body paragraphs, detailing the types, measurements, and causes, and drop in real examples. Actually, do not forget the additional part. This is often where they want you to critically evaluate how effective the SARB's monetary policy or the government's fiscal policy has actually been in South Africa. Finally, wrap the whole thing up with a strong conclusion summarizing the final impact on the economy.
Finally, Section 6, a final revision checklist to test your knowledge.
Before we wrap this explainer up, let's do a rapid-fire mental check. Can you define inflation, stagflation, and hyperinflation off the top of your head? Can you rebuild that CPI versus PPI table from memory? Do you know the 3 to 6% SARB target? Can you confidently explain demand pull versus cost push causes? And can you walk through the step-by-step repo rate mechanism? If you can talk through every single one of these points out loud right now, you are in a seriously strong position for your final paper.
I'm going to leave you with this provocative thought to chew on and really test your deeper economic understanding. If rising prices are so bad for us, why doesn't the Reserve Bank just force inflation to be exactly zero? Think about what 0% inflation might actually do to consumer spending, wages, and overall economic growth. It's a tricky one. Keep studying, trust your preparation, and absolutely best of luck with your exams.